Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. It has been said that you are to practice daily gratitude. So today it's that portion of the segment where we're going to express daily gratitude for the One Big Beautiful Bill Act and its revisions to Section 1202. Woohoo! Thank you. I can hear you all cheering at home too.
Enthusiasm spewing.
So 1202 is exclusion of gain from sale of certain small business stock. That title is so packed with like, what is certain small business stock? Why is it partial exclusion? So let's get into that. What is Section 1202?
It allows, like you mentioned, it allows you to exclude some or all of a gain from selling qualified small business stock. These are C Corps and non-services companies. And you can exclude, because of the bill, you can now exclude up to $15 million of gains. Prior to the passing of the bill, it was only $10 million. So it's a tremendous benefit.
Okay. Yeah. You said service businesses. What are service businesses?
Well, it's more businesses. Well, let's exclude businesses that are not considered service business. Mm-hmm. So financial service industry would be considered excluded from this. Different industries in the medical industry as well, too, different medical businesses. Mm-hmm. They have a specific list that outlines every single industry that would not be included and not offered this exclusion. So those are just a couple examples.
A sarcastic person might say, "Are you producing anything?"
Yeah.
So I was making fun of our industry.
What are you creating?
I was about to say, I'm producing. If I'm a doctor, I'm producing life. No.
Yeah.
Oh, okay.
Yeah. So pretty much.
A horrible joke.
I got more where that came from.
Yeah. So it's pretty much businesses that are creating something tangible, and so we are not creating unless it's palpable what we create.
I think it was like financial services, oil and gas, real estate investment trust. I think that it would really there's a handful of, like you said, particular ones that are excluded, but I think more importantly, right, you want to make sure yours is or is not.
Yeah. Okay.
You got to do the due diligence.
I see. So are there any other qualifications to be considered small business stock?
Yeah.
Oh, yeah.
Yeah. Now, because of the bill, it's a company that has less than $75 million of assets. But prior to the passing of the One Big Beautiful Bill, it was companies that had $50 million or less in assets.
At the start of the company or just in general?
At the start of the company.
Okay.
Yeah.
I think it's super important that you note that and have that documented, that what is the value at the start of stock purchase.
Mm-hmm. Okay. All right. Why is it called partial exclusion? How does that work?
Yeah, because depending on the size of the business, there's a limit on the total amount that you can exclude. And so depending on the way the C Corp is structured and the ownership, right, you're allotted up to that 15 million exclusion per owner. So the way that you can structure it, you can obviously increase that exclusion amount up to a higher amount, depending if you have a spouse part of ownership or family members part of your ownership, multiple owners. You can then expand that exclusion. And then what the time frame of the exclusion also changed with the bill. So prior to the bill, there was a 5-year requirement for the exclusion. Now that's changed, where you can start to exclude a percentage of it after just 3 years. So at 3 years, you can exclude up to 50% of it. 4 years, that then increases 75. And then once you hit the 5-year mark, then you get the full 100% exclusion as well.
Okay. Y'all mentioned C Corps.
Mm-hmm.
So are you saying that I can buy stock in a multinational publicly traded company and I can exclude the gain off of that stock if I've held it for 5 years?
Well, so the size of the company matters, right?
Okay.
That's we had mentioned. So
is that the only thing that matters?
And it can't be a publicly traded company.
Why is that?
That's a good question. Well, this is designed to support smaller companies, that not publicly traded companies tend to be bigger and have assets more than $75 million.
Okay.
Yeah.
So, all right. So then if I buy my shares from somebody, privately held,
Right.
closely held business,
Right.
and I were to sell those shares 5 years from now, would I be able to do that tax free?
Unfortunately not.
Why is that?
You have to buy, to qualify for a qualified small business stock, you have to buy it.
Sorry, and I hope this makes it in the podcast. I tried. You can lead a horse to water. You can't make them drink, no matter how many times you've rehearsed it ahead of time.
Say it a different way.
Yeah, you can't purchase the shares in secondary market.
Yeah.
Oh, say more, sir.
It has to be so the purchase has to be done as it has to be an initial purchase.
Original issuance.
Original issue, yeah.
Right. So so if it's a publicly traded company, those are secondary shares as well too.
Oh, is that the way that works?
Yes,
Okay.
yes, correct.
But what about if they're not publicly traded?
Same thing. It cannot be. It has to be original issue.
Ah, okay.
Yes.
All right. So, all right, I'm gonna go down the rabbit hole with you.
Here we go.
Okay. So, right. So if I were to gift my shares to my adult offspring, I always feel weird calling adults child.
Yeah, me
but
too.
I think
Or
you know what it is.
offspring.
Adult son. How about that?
Son.
Yeah.
If I were to get or daughter,
Non-minor.
whichever you prefer, a non-minor, yeah. If I were to gift those shares, will that adult child, be able to sell them tax free?
In this circumstance, yes, because of their family members. So that you're allowed to gift the ownership with the family, and it still maintains the original issue.
Cool. So could I even use that as a planning technique? Like, let's say, aren't there others? Sorry, I'm jumping around. Isn't there another limitation, like a certain multiple?
Yeah, it's the greater of $15 million now because of the bill, or 10 times your basis.
Okay.
So technically, if you can exclude more than $15 million if it's 10 times your basis, and your basis is a bigger amount. Yeah.
I believe they can only sell a certain percentage to in a given year. If they sell over, I believe it's over 5% of gross of the overall assets, that also reduces their eligibility for tax free.
Is that for redemption purposes, or is
That's
that
for redemption
redemption
exchanges.
Yep.
Okay. Since you went there, let's put a pin in it. We'll come back to the
Yeah.
thing. But since you went there, all right, can you explain the difference between redemptions and sales and that 5% thing?
Yeah, so some people might be in a situation where they're thinking of selling it before the 3-year time frame and not have any exclusion of their gains because they probably had a big run up. And so with Section 1045, you can actually sell your QSBS, and if you use those proceeds to buy another qualified small business stock within 60 days, you can defer your capital gains taxes.
All right, we're putting in a bunch of pins. I promise you, we're gonna get you there.
We'll get you there.
And you know what? This one's on me. My dad used to say, a good leader always takes the blame and never the credit. So I'll take blame for this one. We're gonna start talking about 1202 pre and post OBBA, and then we're gonna go into other tax deferral strategies, such as qualified small business stock, as you mentioned, ESOPs, and structure installment sales. So you went to the qualified small business stock.
Yes, sir.
When we were talking about redemptions, that is a little bit different than cross purchase. So, for example, let's say you and I are co-shareholders. I can buy your shares from you, or the C corp can redeem my shares, and that is a redemption. So, how does that impact 1202 to what Alexis was saying earlier?
Yeah. So redemptions are allotted if structured appropriately. And so what Alexis was referring to is you want to try to stay underneath 5% of the total asset value in the redemption within 1 year. When you start getting over that threshold, it starts to trigger some things tax-wise by redeeming too much of the total stock value within a very short time frame. And so recommendations is to stay within that 5% within a 1 year 1 year period. So every year, if you want to start redeeming more over that time frame, you can still claim 1202 and maintain that structure to be able to allot that redemption.
Yeah, so probably should have also given this disclaimer on the front end. We're not tax professionals or legal professionals. We highly recommend you consult your tax and legal professionals. We're just financial advisors trying to give you some information.
Yeah, but I think the big thing, right, is making sure you're planning, right? I think if you're having these conversations, planning it out, you can make sure to stay within those guidelines.
Yeah. So just to be clear, a redemption is when the C corporation is buying a shareholder's shares. Okay. We're going to come back to 1040. That's 1042, right?
1045.
Or 1045. 1045. We are going to talk about 1042 later, but we'll come back to 1045. Okay. Back to the first pin. So if we trip up those limits about 10 times your basis or $15 million, marrying that with, could it be a strategy where you gift shares to family members if you're going to trip up that limit?
Yes, it's a strategy called layering. So what it allows you to do is be able to gift shares to those individual family members. The ownership structure can come in any format. Like the shareholder can be anything. So the shareholder can be a pass-through entity, it can be a trust, it can be obviously an individual. But dispersing and gifting to separate ownership will then maximize the eligibility as far as the total dollar amount you can exclude. And so it is a fantastic strategy to start to be able to do that, be able to spread the ownership across multiple parties so that upon sale, the limit for your exclusion then increases based upon that total value per each individual owner.
Okay, cool. Okay. So since we love hypotheticals on this show, so what I hear you saying, could I just take a bunch of my money, put it in a C Corp, and buy a bunch of individual stocks, make a lot of money, and then 5 years from now, sell the C corporation that holds all those stocks tax-free? All right. I have $1 million. I put it into the C Corp. This $1 million in the C Corp buys a bunch of individual holdings. Quantum computing stock, for example, because I think over the next 5 years, this whatever, blah, 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 blah. And let's say it does come to fruition. That $1 million turns into $5 million. Can I sell my C corporation stock tax-free? Not the quantum computing stock in the C corporation.
The C Corp itself.
Is your C Corp the parent company of all these subsidiaries?
Well, those aren't subsidiaries.
They're just individual holdings.
You just have holdings?
Yeah, so I open up James Enriquez Investments Inc. with $1 million, and that goes and buy invest portfolio. The value increases from 1 million to 5 million. Can I sell my shares of James Enriquez Investment Inc. tax free?
I don't think in this situation, because it's a C Corp, you can only qualify if it's a non-C Corp that's holding the stock.
I'm holding the stock. James Enriquez is holding the stock of James Enriquez Investments Inc.
Gotcha.
Yeah.
The 80-20 rule.
Yeah. Yeah. So also it doesn't depend on it being a service company as well too.
Ah, very good point.
So that wouldn't qualify for eligibility there.
Yeah, but what about the active business requirement? Can we talk about that?
Well, the fact that you're not actually conducting a business, right? It's basically just holding stocks, right? So therefore, it doesn't meet the requirements that the IRS requires in order for it to be a qualified small business.
Well, what are those requirements?
Has to produce income.
Spotlight.
Noe, do you want to give this to us?
Yeah. So at least 80% of the corporation's assets must be used in active conduct of a qualified trade or business. So that would explain that 80-20 rule.
Yeah. Thanks, Noe.
Awesome.
There you go.
Would any of you guys like to add anything to that? Or that's pretty straightforward, I guess.
Yeah. Specifically on 1202, it is a highly regulated tax strategy. So one of the biggest things that we recommend clients doing if you're considering this is like years of planning prior, right? And understanding documentation that you have to have in place. And when you're going through this process, knowing what the requirements are, what that documentation needs to look like for IRS purposes, because this is such a huge tax benefit with this strategy that the IRS considers it a huge red flag when they see this come up. So make sure you're doing your due diligence as far as just really documenting and really noting and making sure structurally everyththing's in place the right way.
Yeah, I would say minutes, valuations, articles of incorporation, all that good stuff.
Yep.
Yeah, because it's up to you to provide all information for this to qualify, right? If you fail to provide any of this information, right, the IRS is pretty, they're pretty stingy, right? They want their money, right? And they're not going to, I guess, allow you this tax-free benefit that is really that powerful.
Yeah, you're claiming tax-free income, you better believe somebody might come knocking. Okay, so James mentioned earlier about rollover or qualified small business stock section, Internal Revenue Code section 1045. Can you talk a little bit about how sometimes people use this and 1202 together, and what is 1045?
Yeah, that's, for example, this year you can exclude up to $15 million, but let's say you sold a stock and the gains are $30 million, which is double the exclusion amount. So you can take advantage of the $15 million exclusion, but then you can go ahead and use the proceeds within 60 days and buy another qualified small business stock, and you can defer the gains.
Yeah, the benefit is that your time doesn't reset as well too. So that's the biggest thing, right? So you have to meet those 3, 4, 5 year time holding periods, and so the basis of the company would remain when you originally purchased it. So the deferral, what it does is deferrals over into that new company, but your original purchase time frame still remains the same. So like your example earlier, if you purchased, if you had that company and you had a quick run up in a 2-year time frame, that 10-4, and then you wanted to sell some of the proceeds, or in the 3-year time frame, you were able to exclude some of the proceeds. The remaining proceeds that aren't excluded, you can then 1045 into a new company, wait a couple more years, and at that point in time sell and claim the exclusion based on the holding period.
Wait, so you're saying I can use 1202 on the 1045 stock and combine the I did not know that. That's kind of cool.
Yeah.
Can you talk about the other lesser holding period of 1045? So say you weren't marrying 1045 and 1202. What's the holding period to be able to use 1045?
2 years.
6 months.
Same thing.
It is 6 months, right? Isn't it?
For whatever reason, why I don't know why 2 years was coming up.
No. Yep, 6 months.
6 months. Okay.
Confirmed off camera.
Good. Thanks, Noe.
Thank you, Noe.
To section 1045 for QSBS rollover, the minimum holding period is more than 6
months.
Yeah. So, in other words, not trying to nitpick. It's just that if you don't qualify for 1202, you might be able to qualify for 1045.
Yep.
Now, it's not as powerful as 1202 because 1202 is tax free, right? Or exclusion of gain, partial. This one, you're just deferring the taxes. So you'd be going from qualified small business stock to qualified small business stock. So you still have all the same qualifications of QSBS, non-service business, asset level, all that good stuff, original issuance, everything. Okay. Can y'all think of anything else you'd like to add about 1045? I mean, because that's pretty much it, no?
No, I mean the circumstances really come into play when you're not hitting your holding periods. That's a big part of it. And then obviously once you've exceeded those thresholds, but it's a good problem to have.
Yeah. Right.
Yeah.
If you're a serial entrepreneur, this is also a very viable thing.
Yeah, exactly.
Yeah.
Exactly.
Okay. So let's talk a little bit about since we're on this subject, let's talk about 1042, which is ESOPs. What are ESOPs?
Oh, good.
I was just saying, so it's employee stock option plans.
Yep.
It allows employees to be able to have a chance to become ownership of the businesses that they work for. It creates different types of environment, longevity, and it offers a exit plan for the business owner.
Okay.
Yeah, it's like a retirement plan but the employees aren't contributing themselves. So the employer is providing ownership shares of the company to their employees in a retirement account, and they own those shares, and it provides it's a tax strategy for the employer, and it's also a huge incentive for employees to gain ownership of the business.
Okay. How is it a tax strategy for an employer?
If an employer sells their stock directly into the ESOP and the value of those stocks is 30% of all the outstanding value. They can defer gains by buying qualified replacement property, which is our other U.S. domestic corporations, and they can defer gains by doing so.
Yeah.
Yeah.
So U.S. domestic corporations, is that like mutual funds, ETFs?
It can't be a mutual fund or ETF. Has to be an individual stock.
Okay.
Yeah.
And when do I have to do that? Can I do it like 2 years later?
I can't recall the time frame. I think you have 12 months.
15 months, 3 months prior, 12 months after.
Right.
12 months after.
Yeah.
And it's not just a stock of U.S. domestic corporations, right?
No. You can even do real estate. Yeah.
I don't know. I think you can do bonds.
Right. But it has to be individual bonds.
Right.
Not through a mutual fund or ETF.
Yep.
Yep.
Okay. That's a tax deferral strategy. If it's a C Corp, if it's an S Corp, whatever shares that are sold to the ESOP, those shares that are owned by the ESOP will not pay income taxes. So it's not quite a tax deferral strategy, which is the point of this podcast, but there is some tax incentive. You mentioned 30%. Can you expand on that a little bit? Like, what if I have a child that is working, adult child? What if I have an adult child working in the business?
What if I have a son who's an adult?
Or daughter?
Or daughter.
Son or daughter working in the business.
Non-minor.
Two.
Just non-minor.
Non-minor. Thank you. We're not breaking any child labor laws here, okay?
Yeah.
Can they receive shares from the ESOP?
They cannot. So here's the sorry. They cannot. Yeah, so you can't it's pretty much disallowing you to transfer shares for tax purposes for a gifting aspect and still get the tax deferral and just transferring it over when avoiding the tax liability.
Yeah, I think the point we're trying to make here is you got to be aware of the rules. Seek out a qualified professional to get to wade through all those nuances, right? Because if you want the tax deferral treatment, there's certain rules you have to abide by. Okay. Sorry, we're whizzing through this. Let's talk about structured installment sales. But before we talk about structured installment sales, let's talk about installment sales. What are installment sales?
Installment sales are going to be a transaction between two parties, and there's going to receive a series of income over a specified period of time.
Okay. How is that taxed?
Depends if there's depreciation, depending on what's being sold, right? So if it's real estate and there's some depreciation, what happens is all that depreciation is recaptured on the front end. So you pay taxes on the recaptured depreciation at the very beginning, and then every year that you receive the payments, that year is what you pay your taxes on that specific payment. So if you did some type of agreement where you sold, let's say a piece of real estate for $1 million, and you have a 10-year sale or installment sale, every year you're getting $100,000. Well, part of that $100,000 is going to be cost basis. Part of it's going to be capital gains, and then you're paying ordinary income on the interest at that point. And then you're doing that every single year over the length of the sale, of the installment.
So cost basis is non-taxable?
Cost basis is not taxable. Correct.
Yeah. So why would somebody want to do that as opposed to just paying it all in 1 year?
Yeah, I mean, if you're paying it all in 1 year, then you're paying a large capital gain payment and taking on a huge capital gain payment at one point in time. So it's all tax strategy. Some people may, right? It may be something that you consider just based upon whatever your financial situation is. But if you want to spread that capital gain liability over a further length of period of time, and generate maybe a stream of income instead of having it all at once, you have some income coming in over that time frame. You can do so as well, but it really is just to spread the tax liability out.
I think planning is important, right? You want to avoid net investment income, right? And for some individuals, that might be costly, especially if they have other entities, real estate or other flows of income that might really kind of negatively impact them. 3.8% might not be a lot, as to some people pay 5% in gas. Was it coffee?
Yeah.
Drive-through, but that 3.8% on a lot of money might be.
My friend Alexis is talking about convenience fees that apparently now pop up on receipts. But
Drive through.
that was a good one. I like that.
Yes.
Literally just happened.
5%, buddy. Woo.
We didn't rehearse that one. That was
No,
good.
that was good.
Okay. So what is a structured installment sale? How is that different than a regular installment sale?
The difference is you now incorporate a third party. So typically this is a life insurance company, and the process is then done through an annuity. So you're utilizing an annuity to provide income for the sale process. So in the same scenario, a real estate property, $1 million, and you have a buyer, you work with the buyer says, okay, I'm going to purchase it for this price. I'd like to do, seller says, I'd like to do this through an structured installment sale. You bring in an insurance company comes in, takes on the role of providing the stream of income over the term of that time frame. So they're utilizing them to provide the annualized payments over to the seller. In place of the buyer paying that out over that time frame.
Yeah, I think you can even defer it to, like, you don't have to start taking income right away. You can defer it to some future year,
Yep.
which is why we talked about it in this.
Right.
Yeah. Okay. All right. Couple of omissions, errors and omissions, as my friend likes to say. There's a holding period for ESOPs. Okay. I probably shouldn't say this because I probably shouldn't antagonize our friends over in compliance, but there is another tax deferral strategy that was changed by the One Big Beautiful Bill Act that originally came into place by the Tax Cuts and Jobs Act of 2017. You can just Google what the strategy is, but that's another tax deferral strategy. Can't talk about it here, though. Anything else we should probably talk about?
I think it's just planning, right? I think it's important to reiterate planning, documentation. I think if you do those two things and you have some sort of idea where your business you want it to go, whether it be to your loved ones or whether it be to the public or to your employees, I think you can always figure out, right, how to go about it and basically keep as much of it as possible, right? Because no one wants to pay taxes, right? So,
yeah, I'm glad you brought that up because I will say that all the stats are there. There's going to be a lot of businesses that are changing hands as our demographic ages, and we always say it's not what you make, it's what you keep. So if you can implement some kind of tax avoidance, tax deferral, or even tax-free strategy like 1202. Just by holding on for a little bit longer, so you meet the time, the holding period requirements.
I mean, that's a huge difference in returns, right? I mean, for some individuals, that's up to 39%, 33%. I mean, you're talking about significant tax savings.
Is that a lot? 40% of what you make?
It can be.
Okay. Well, again, we're here to help. Consult your tax and legal professionals. Thanks for tuning in to another episode of Our 2 Cents on Your Dollars. Please follow, like, and subscribe. Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.